All right, let's get right into it. If you're invested in AI, you've probably loaded up on the usual suspects, right? But today, we're going to break down a completely different strategy. A high-conviction portfolio that's been stripped down and rebuilt into what the source material calls an AI weapon. It's a really fascinating look at where the real money might be made next.
And that really gets to the big question on everyone's mind. After this massive run-up in the big tech names, is the easy money gone? Did we miss the boat? A lot of people are feeling like the biggest gains are already in the rearview mirror. Well, the analysis we're digging into today starts with a pretty provocative answer.
And there it is, a direct quote from the analysis, and it's aimed squarely at NVIDIA. Yeah, calling a market darling like NVIDIA dead money is a seriously bold, contrarian stance. And you know what? It perfectly sets the tone for this whole strategy. This is not about following the herd. It's about making disciplined, calculated bets on where the future is actually headed.
So, if the opportunity isn't in the obvious places, where do you look? Well, the core idea of this portfolio is that the AI gold rush is shifting. The real constraints, and therefore the real opportunities, are moving from the world of silicon chips to the world of steel, power grids, and pure physical infrastructure.
And you can see how this all played out, right? At first, the bottleneck was just getting enough compute chips. We kind of solved that. Then it was about connecting those chips with enough high-bandwidth memory. That's being solved too. But now we've slammed into a hard physical limit. Having enough raw power, a grid that can actually deliver it, and the crazy advanced cooling to keep these massive AI data centers from, well, melting down. This is the new frontier. So here's the bottom line. The next wave of AI growth isn't going to be held back by a lack of chips. It's going to be held back by a lack of watts and cooling pipes. And if you believe that, the data center power demands are about to double or even triple in just the next few years, it completely flips the script on how you should invest. This entire portfolio is built from the ground up to capitalize on that one powerful insight.
So how do you actually play this shift? Let's take a look at the portfolio itself. The strategy is structured as this three-tiered weapon, where each part is designed to capture a different angle of these new physical bottlenecks. Okay, so you see the breakdown here. The lion's share, 55%, goes to what are called the monopolies. These are companies with just unassailable competitive advantages. Then the core thesis is played through 35% in kinetic infrastructure. Those are the power and cooling plays. And finally, there's a 10% slice for asymmetric bets. These are the high-risk home run swings.
Tier 1 is all about pricing power. You've got SK Hynix, which has a 62% monopoly on the high-bandwidth memory that's absolutely essential for AI. Or look at TSMC. They have a literal monopoly on the physics of advanced chip making. These aren't just market leaders, they're structurally dominant companies that the entire AI ecosystem depends on.
Now, inside this monopolies tier, the analysis zeroes in on Alphabet as a, quote, criminally underweighted opportunity. The target upside, 115%. Just let that sink in. The argument is that its combo of the search monopoly, its own advanced AI chips, the TPUs, and a pretty low valuation makes it the most attractive giant cloud provider out there by a mile.
Okay, now we get to the absolute core of the thesis. The picks and shovels. This isn't speculative stuff, it's tangible. You have Quanta Services, which basically has a monopoly on the specialized skilled labor needed to upgrade our ancient power grid. You've got Constellation, providing the 24/7 nuclear power that these AI data centers are starving for. And then there's Vertiv, with a monopoly on the liquid cooling tech that was literally co-engineered with NVIDIA's latest chips. These are the companies physically building AI's future.
And next up, the moonshots. These are the high-risk, high-reward plays. It's only 10% of the portfolio, so the risk is contained. You've got Oklo, which is a pure bet on the future of tiny microreactors powering data centers. And then Qualcomm, a bet on the emerging AI PC market. Computers with special chips to run AI right on your desk. These are the plays that could either fizzle out or they could deliver 10x returns.
So we've seen what's in the portfolio. But, a strategy this focused is defined just as much by what it leaves out. To fund these high-conviction ideas, some of the absolute biggest names in tech had to get the axe.
And this right here shows you just how ruthless that pivot was. Capital from NVIDIA was redeployed into SK Hynix. Microsoft was sold to buy more Alphabet. Amazon and Apple were cut to fund bigger positions in those core infrastructure plays like Constellation Energy and Quanta Services. It's a straight-up shift from popular, lower upside names directly into the core thesis.
And the thinking behind it was brutally simple. NVIDIA, it was seen as having limited upside left. Microsoft's 10% potential upside just wasn't enough to justify a big holding. And both Amazon and Apple, they were viewed as lacking the immediate AI catalysts to warrant being included. The goal was to be completely unsentimental and reallocating every single dollar to the highest conviction ideas.
Okay, so after all that reconstruction, the cuts, the concentration, the laser focus on this new bottleneck, what's the result? What did it actually accomplish? Let's look at the numbers and see how the portfolio was transformed.
This is the payoff, right here. The original, more diversified portfolio had a weighted average upside of about 22%. The reconstructed portfolio, this new weapon, has a weighted average upside of 47%. They more than doubled the potential return just by focusing capital on the best ideas.
So, how'd they do it? Well, it was all about concentration. The number of positions was slashed from 24 down to just 11. The concentration in the top 5 best ideas jumped from 33% all the way to 55%, and all the illiquid stuff was sold off. This is the very definition of a focused, high-conviction strategy.
Which brings us to this final quote from the analysis that just says it all. The shift was from a broad, diversified portfolio that looked like a compromise to something sharp, focused, and purpose-built, a tool designed for a very specific mission.
So the real takeaway here isn't just a shopping list of stocks, it's the thinking behind it. This whole strategy is a bet on power and cooling, but it leaves all of us with a bigger question to think about. As we solve these problems, what's going to be the next hidden bottleneck in this AI revolution? Because finding the answer to that, that's where the next huge opportunity is going to be.